Hey guys, this video is on how to pick a stock. So now at this point you've seen why it's important to invest, but now that you do, how do you pick a stock? How do you know which one's good and which one's bad? So that's why I have here comparing apples versus oranges. So I'm going to give an example here. I've got two companies. I need a food stock because remember you want to be diversified. So I need to fill my food section of my portfolio or my consumer non-cyclical, because remember that's where people will continue to pay for something even though it's in a bad economy. So food stock here, and I have two companies, two very well-known companies. You have Chipotle, Mexican Grill, and Taco Bell. Both of these are foods. They're both Mexican restaurants as well. So how do we know which one to invest in and what's a good investment or which one might not be a good investment? Just remember the judging criteria. When you look at one stock versus another, these five are the most important, at least I feel, for the fundamentals of a company. The most important is growth potential, because if a company can grow, so will their stock and so will your money. So growth potential is very important. Profit margin, how much money are they making? Price per earnings multiple, so this kind of tells you their price per how much money they're making, and that's really the true value of a stock. Earnings per share growth, so looking to see how much their earnings or profits are growing over time, and then looking at how much debt to how much money they have is another important criteria. So the first one, growth potential. I've got Chipotle over here, MAP, and Taco Bell over here. When you're looking at the growth potential of a store or a restaurant like this, it's really about how many restaurants, or where else can you put restaurants, or where else can you put these stores. And here we're looking at a U.S. stock, so we'll look at the U.S. and potential growth with the U.S. So if we start off by looking at Taco Bell down here on the right, we'll see all the different locations are these purple dots. And you can see there are a lot of Taco Bells. So the potential to grow might not be that big with Taco Bell because there are already a lot of Taco Bells already out there. If we look over here at Chipotle, you can see with their red dots. And if you compare Chipotle versus what we saw with Taco Bell, you can see there's not as many. So there's still potential there. Chipotle has a high growth potential because you can still have a lot more Chipotle restaurants. Just like a couple weekends ago, my wife and I had to drive down to Greenville to get Chipotle because we love Chipotle, and there's a potential to put a Chipotle in Asheville. So there's a high growth potential, more with Chipotle than with Taco Bell. Profit margin, I've got Taco Bell on the top, and this data here goes with Taco Bell, bottom Chipotle. So if we first look at Taco Bell, we can see their gross profit margin actual is about 52%. The industry average for these food restaurants is about 38.7%. That's really what we'll look at here. And then Chipotle, you can look down as well. Their profit is at 26% versus 38% as the industry average. So I'd say with profit, Taco Bell is really doing well here over Chipotle. Both their operating and net profits are about the same. There's not much of a difference there, and that's just looking at within the company and their operations. How well do they profit from those operations? Are they expensive or not, or costly? So there's profit margin. It looks like Taco Bell's in the lead for this one over Chipotle. Price per earnings. We've got Chipotle here on the left. Let's look at it first. This information down below is the summary of a stock, which normally you'll see when you first pull up a stock on different websites like Morningstar or Google or TD Ameritrade. We can see down here we have the price per earnings multiple. This one is 58.4, which is actually really high. So that means how much people are paying versus how much the company earns is much higher, which is a bad thing. So you want this number to be lower. You want it to be somewhere around 15 or 20 or below, depending on what the market or the index is that it's in. And really, you want it to be around 20 or lower. Let's go over to Taco Bell. If we find its price per earnings, it's at 21.8, so it's not bad. So that the value of that stock is kind of around the average of the index that it's in. And I think Taco Bell and Yum is in S&P 500, which is an index which you learned from another video. But that's not bad. A little bit lower would be a little bit favorable, but definitely Taco Bell is beating Chipotle in its price per earnings multiple. Next, we're looking at earnings per share growth. Here we have Taco Bell on the top, Chipotle on the bottom. If we look at Taco Bell to begin with, we're looking at a trend here, and you can see it goes from 2011, 2012, 2013, 2014. Well, you're looking at a trend, and you want to see growth. So if you did a best fit line, we would say that it kind of is here, then it goes up a little bit, and then kind of the same for 2013 as 2012, and then kind of the same for 2014, 2014, 13, and then a little bit higher for 2015 for their projected growth. So their growth here is a little bit, but still kind of static, not really moving. If we look down at Chipotle, we can see it's 2011, and then 2012 it grew a little bit. 2013 it grew a little bit. 2014 looks like they're projected to grow even more. In 2015 they're projected to grow even more. So I'd say Chipotle has the best earnings per share growth over Taco Bell, because you can really see that upward trend from the year to year. So that's a little bit better than what Taco Bell is showing. Last thing we want to look at is their debt and their debt to their equity. And equity is just their money and assets and things that bring in money. If we look at Chipotle first, blue is showing equity and red is showing debt with the pie chart. And here just looks like blue, so it looks like they have no debt, which is good, is a very good thing. Debt is not bad to have, but too much debt can be a problem if the economy does not do well or starts to do worse or starts to head south. Having a lot of debt can be really a burden for a company. So if we look over to Yum Brands, which Taco Bell is owned by, their equity is in blue again, debt in red. You can see they're over halfway, maybe 60% filled with debt, and then only about 40% equity. So in a bad economy, this stock, it seems, would probably drop pretty fast. So that's the debt to equity versus Chipotle versus Taco Bell. So here we go. At the end, we want to do like a comparison chart. I've got my criteria here on the left. I've got Chipotle and then Taco Bell. Once again, look at growth potential. Chipotle wins with their high growth potential. Profit margin, looks like Taco Bell is doing a little bit better. Price per earnings multiple, Taco Bell once again takes the lead with that one. Earning per share growth is increasing more with Chipotle, so they got that one. And then debt to equity, looks like Chipotle wins with their no debt. So here we go. What company would I choose? Would I choose Taco Bell or would I choose Chipotle? What would you choose? Me personally, I don't think I would choose either. I think I would have to do more research in this field of stocks, this sector, to find a better company. I want that large growth potential, but I want a higher profit margin, and I want a lower price per earnings multiple. I do like the earnings per share growth and the debt to equity, but I think I can find a better stock out there that can have all of the things that I want. So I'm going to have to do a little more research to look at other food companies that I might want to invest in and do this same process with each of those. So there it is, picking one stock over another. That's the process you want to follow. You will do more than just two stocks when you're picking, but this is what you want to do. And if you do have any questions, let me know.